Hello traders, Gary Wagner here, just about 9:30 in Honolulu, 3:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 14th day of March 2014, and this is the daily report for gold and silver, a special report, our weekend review. And wow, we are seeing this market really taking off as we go into the last couple of hours of trading on Friday. We are substantially higher on both gold and silver, lower on platinum and palladium. As you can see to the board, call it 1381, 1382. The high, 1389.60. The low, 1367.30. Current print, call it 1383. Puts it up about $12 on the day, or a net gain of almost a full percentage point. Silver also showing a higher print, up about 31 cents on the day, although well off of the lows. You can see the highs up here. Those highs are sitting at around 21.89. Current print 21.46. Low on the day 21.06. That's up about 1.5%, up almost 30 cents on the day. Traders, obviously, gold is reacting as a safe haven asset or investment. With the referendum coming up this weekend in the Ukraine, you can see this market has been moving and moving solidly. However, if we take a look at the way this market has moved, and we've talked about this, this is the second of our bottom here, and you can see that the market has come up, over $200 at this point, looking at, call it 1180, or just about 200, I should say. Now it's up to about 1380, 1381. So we've seen a very strong move in the marketplace. Most importantly, on a technical basis, there are a couple of things that we want to talk about today. And the primary emphasis that I really believe needs to be stressed on today's report is that we are quickly mounting compelling technical evidence that's pointing to the fact that we are probably on the onset of a major bull cycle. I've been talking about this over the last couple of weeks, and let's spend a couple of moments to talk about how this really developed. We're looking at a 2-day chart, and on this 2-day chart, I basically have our current Elliott wave count, and I am pending that right now, but here's what I'm looking at and here's what I'm talking about. There's absolutely no question whatsoever that what we experienced, and this is really back from 2008, was the second leg of the Super Bowl cycle. The first started 2002, culminated when we saw gold hit about $1,000, and from there it backed down to about $700, and this is where it's backing down. So this is the second leg. If we take a look at the market move from, say, 700 to 1900, there's no doubt we were really solidly embraced in a bull run in the market, a Super Bowl cycle. We saw this market under fire. We went into the beginning of our correction, and it threw many people off, really, as that market hit 1900, and we had really a series of market activities, and the characteristics of that market was that we had this top at 1800, and we also had very strong support at about, call it 1500 to 1535, and you can see that right in here. So the market really then oscillates between these two price points, meaning it's got a range of roughly $300, 1500 to 1800. We saw the market on 3 occasions try to take out 1800 to move back to these former highs. To no avail. The market simply sold off. The market was simply under pressure, and we went into a solid bear market and a solid bear count. On that bear count, when we look at the marketplace itself, this is that last of the tops, the market genuinely comes down from about $1,800 to the first of two bottoms at 1181. Then we saw really the one real rally of last year, in which we saw the market go from 1181 to 1435. Here's a key. We talked about the fact that we have this long-standing resistance line, and this resistance line is really drawn from these series of tops as the market comes down. And what we noticed is, as the market was in its rally last year, this is June, July last year, it hit this particular resistance line pretty much like a brick wall, and from there came lower. We're definitely still within a bear count and a bear market. It attempts one more small rally, this rally from about 1260 to right again to the upper levels of this resistance line, but it couldn't break through. Now, the first real indication that we were really turning around, of course, happened when we hit this double bottom being at around 1181 again. Now, the fact that we hit that 1181 twice, this was our double bottom, of course, and then as the market moved up, we realized that we would really determine whether or not we were going to continue in our bear market during this recent rally, because if it came to this long-standing resistance line and then bounced lower, it really told us we were still in this downward wave. However, that was not to be the case, and the market broke out solidly to the upside. Of course, our daily viewers know that we took our first stab at the market at around 1258. Got in and took a nice $62 out of the market. I think we got out at $13.25 and got back in at $13.33, and now the market is sitting at 83. So we only missed a couple of dollars on this rally. We did take it in right when it broke out. But here's the key. I had initially thought that what we'd probably see was some sort of an A, a B, and a C, because my belief was at that point that what we were experiencing really could be best characterized as a counter trend. And on a counter trend, as we talked about a little bit last week, we're looking for three waves, something like an A, a B, and a C. And then you would get a continuation to the downside, this whole downward trend, and this just being what we call a counter trend, meaning it's not a new trend but a counter trend. However, there's some real compelling technical evidence that's beginning to point out that we might in fact be at just the doorsteps of a super bull cycle to the upside. And let me show you what technical evidence I'm looking at, and then you can judge for yourself as to what kind of validity you see in these studies. So I draw your attention to this chart. It's a daily chart. And what we have put on this chart is a basic Andrews pitchfork. Basic Andrews pitchfork is derived from three data points. First data point is this record top, and that of course is going to form our midpoint or our handle. From there we go to the highs and then the lows, the high being 1800 right here, the low being 1500 right here. And what that allows us to do then is to put in the 0 and 100, meaning the outer prongs on this pitchfork. And so what we look for when we look at a pitchfork like this is, there's no doubt the market's in a downtrend, and so what we want to do is have these cascading channels down. And the way that we'll use it is, as this market breaks, for example, here, we take a look to see if it finds any kind of support at any of these different levels, this being the 76% level. You see it finds support, but then it finds resistance at the 50%. Market then comes to the bottom of this rung here. This is at 100%, and this is the first of the double bottoms. And you can see here's these two double bottoms. They don't look like they're identical in terms of the lows, but that's because of the cascading channel lines. As it comes up, though, just as we had that long-standing resistance line, you can see that it found resistance at that 23% level. Now, it comes down, and here we've got the market making a play and just at the zero mark or the outer prong on the Andrews pitchfork. Now, here's what I believe. My sense is that if in fact we get a break above this particular prong, the zero line, that is a really strong technical signal that we have in fact broken out of this long-standing bear market. And in fact, a move above this would signal the potential that we're not looking at a counter trend, but what we're actually looking at is a bullish trend. And traders, the ramifications are tremendous, because what that means is that market hits its bottom, and rather than having an ABC, we might get something like a 1, 2, 3, 4, and 5. In other words, we would go back into an impulse phase being defined as a bullish rally to the upside, waves 1, 3, and 5 being our uptrend, strong rally points or rally waves, and then our counter trend would be, of course, 2 and 4, just as we saw as this market moved up. That, to me, is a tremendous piece of information, because with that, we can ascertain really a new look in terms of the different models that we're currently working with. And here's what I mean. Traders, I've just put up a spot market gold chart, Japanese average format. And here what we're looking at is really the major count within the market. Because as you recall, when we looked at our basic Elliott wave, what we were looking at is this major move here, and we saw a series of 5 waves, 1, 2, 3, 4, 5. Then our corrective period, but we felt that this is probably, we're in a full-blown bear market. We're going to have this counter trend and go into an ABC corrective stage. The model that I'm currently looking at starts our super cycle at 2002. Gold is trading roughly at 300. 300, we get a move up to just over 1,000. From 1,000, we correct. This is our major 1. This is our major 2. From that major 2, we go into a dynamic major 3rd that takes us to a new record top at 1920. And at that point, we go into a corrective wave. That corrective wave, I believe, can be correctly titled now as M4 or a major 4. And what we witnessed there was basically an A, a B, and this long C down. We terminated with the C, went back into a impulse phase, and that impulse phase could be something like 1, 2, 3, 4, and 5, and it should actually culminate with at least a equal top or close to back to around 1800, if not a higher top. And with this in place, we can really start to do some effective modeling of where we think this market could go. Now realize what I'm referring to is a super cycle. This super cycle is going to take quite some time to unfold when you consider the fact that this major 3rd, for example, really spanned almost 3 years, 3.5 years. The corrections, this one was rather short, but if we look at this last correction, we had a correction that started really at the the end of 2011, right in here after we hit our top, and took us all the way to 2014. So these are long 2 to 3 year cycles. But with that in mind, here are some of the numbers we could look to see. And this, of course, is a very, very broad overview of the market, but bear with me, because I believe that this could give us some real good information in terms of what we can look for over the next couple of years. And here's what I'm looking at. If we take a look at this first move, and this is the move from $300 up to $1,000, then the market corrects roughly 38%. We get a 38% retracement. This is the termination of that major 2nd. We go into a major 3rd. Now, on the major 3rd, in terms of predictive qualities, we're going to look at fib extensions. And so what we've done is we've done a fib extension from this move from 300 to 1,000, and we began right down here at the beginning of the next rally, and that's these numbers here. So you get 161% takes you to 1731, 176% extension takes you to 1847. So what it told us is that this wave 3 was just over 176% extension of our major 1st. Now, then we've created another extension, and on this extension, I'm simply looking at the move in 3. Typically, the move that we see in 3, when we look at our wave 5, this is going to be the major 5, and this is the extension. If wave 3 and wave 5 were equal, you're looking at $2,300 gold. I don't really see that as being the case. Now, a 76% extension of wave 3 would take us to 2068. And then if we look at just the straight extension, 161 from here, took you to about, what is that, 1890 right in here. And that's a 161% extension of wave 1 up to looking at wave 5. So what I'm trying to say is this. If in fact we are on the doorsteps of another leg in this market, what we could see over the next couple of years is something like this. Wave 1, major, major 2nd, major third. We all lived through this major fourth. Thank God it's over. And then our major fifth over the next couple of years, taking us back up to new highs, because the conclusion of wave 5 should certainly be above wave 3. And my benchmark right now is just above 2,000, call it 2068. So that's the long macro view. Now, so what about the micro view, and where are we looking for the market to possibly go over in the next couple of weeks? Well, we absolutely surpassed 1365. That was the first area that I thought we would get some sort of resistance. You can see this on a 9-day. This is a 9-day chart. We're compressing the heck out of it here. But we saw that it stalled for just the smallest amount of time and then flipped upward. The next real level is got to be 1435, because 1435 is that prior top, and that's that top during this one real rally here. My sense is that we could easily see the market move back to that point before giving us any kind of corrective wave and then moving higher off of that. But I feel that there is absolutely the opportunity. Now, this is all being news and rumor driven. With the referendum coming up this weekend in the Ukraine, anything is possible, and in Monday morning could have some wild swings, or I should say Sunday as the market opens in Australia and Hong Kong, in reference to what the perception is as to what's going on in the Ukraine. And if it gets worse before it gets better, we could see this market really accelerate to the upside, breaking through 1400 next week. If in fact they resolve the scenario, which I would hope for but believe at this point is highly unlikely, but if it was resolved over the weekend and it was perceived that the geopolitical uncertainty had diminished, then in fact we could see the market really come down heavily, because realize that this last real clip of the market has been really adding premium as a safe haven, and that premium will stay in as long as there is the perception of a geopolitical uncertainty. If that perception changes, so will the premium that is currently in the gold market. So what about silver? Well, traders, we are long both gold and silver, although silver's not been really doing a whole lot for us. We're in roughly, I think, at 21.18, somewhere around there, so just a couple of dimes below this point. But here's what I'm looking at. Unlike gold that had a definitive breakout from that resistance line, and that long-standing resistance line, of course, was drawn from the tops, when we look at this particular chart, and let's go ahead and compress it so you get a better feel for what this chart is looking at. There we go. All I've actually done, as you can see, is create a simple line from this top at $49 and then matched it to these to form our angle. And when gold moved right to that resistance line, this is back in June and July of last year, you can see that silver really fell short. Very short. Next one even shorter. And as we saw gold moving, we saw silver kind of sitting in this box. It had that very narrow range, call it 18.5 to 21.5 or 20.5, I believe. And as you can see right now, we could in fact be looking at the market trending either way, because realize that we are still sitting below this long-standing resistance line, but we've gotten what's called a scouting party, meaning we had the market trade above it. You can see that right here. And a scouting party on something like this is simply where the bulls are testing the fortitude of the bears. So they'll push the market up to see if those sell orders come in. And lo and behold, they have, because we're well off of these lows. Realize that the equities markets have been under pressure. Silver, unlike gold, is an industrial metal. That's a primary use of that precious metal. And it is reacting, I believe, to the sluggishness in global economies, the concern over in China in terms of their economy slowing down. And unless we dramatically break above this line, my sense is that we cannot be as bullish on silver as we are on gold. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for another daily update and review. And traders, next week could be a very exciting week for gold traders. Talk to you then. Bye-bye.